I have kept the option contracts here, and I have kept the October future contract is also here. October, always the future will trade in a premium to the spot. You know what is the spot? 74.99. Okay. So the future is trading 11-12 paisa above the spot. Okay. So this is the spot. 75 is the spot you consider. So we will try to sell. Here buying is like normal. Buying, you just pay the premium, means for this is 1000 USD. So you are taking one lot. Let us see. If you are buying the at the money CE, that is 75 CE. If you are buying, just go do buy for one contract 2125. So 0.2125. It is 21.25 paisa. Okay. So this is for how many USD? 1000 USD. Okay. For 1000 USD, you multiply this value by 1000. So the margin required, whatever money you are going to pay as premium, is 212.5 rupees. This is very simple. The calculation is very simple. So one contract is $1,000. So whatever price you are seeing here, you multiply it by 1000. Same like Nifty. Nifty, whatever premium you are seeing here, you multiply by 50, right? Here you will multiply by 1000 because it is for $1,000. So now this is for buying. What I have told is this is the ATM CE buying. Same with any buying, out of the money, at the money, PE, CE. For buying, whatever premium is there, you multiply it by 1000. So that is the premium money you are going to pay to the seller. Let us come to the sell side. If you want to sell this option, normally in the equity segment, what is the premium we are going to pay? Let us see in the equity segment. We have some contracts here. This is a call Condor contract here. So I am going to sell 17,700. Let us see if I sell this contract. Nifty quantity is 50. Okay. If I sell this contract, I have to pay a margin of 1,05,000 plus rupees. Means say 1 lakh rupees for Nifty selling one call option, and 17,700 is in the money. So let us see the out of the money. If you sell this, you are going to pay about 84,000, 18,200. If you are going to sell today or tomorrow, the margin money required is about 84,000. Okay. Now let us come back to the currency and say that the at the money C I am going to sell. What is the margin to be paid for one contract? This is not error. The value is so low, but this is not an error. This is the margin what is required to sell one contract of USD INR at the money CE. Just 1793.53. Just under 2000 rupees only for a single lot. So people do not sell one lot. Okay, people sell multiples of 50s and 100s because the margin money required is very, very low. If we sell one lot here, and if the spot is moving by 1 pip is like 0.0025. If it moves, you will gain 2.5 rupees. Means for, you say 1,800, you say 2,000 rupees is your margin. For 2,000 rupees, for each tick in your favor, you will gain 2.5 rupees. Each tick not in your favor, you will lose 2.5 rupees. Okay. So 2.5 rupees is nothing, because if you sell in any broker, your minimum for an order you will pay 20 rupees brokerage, right? Means getting for one tick 2.5 rupees is basically nothing. So people don't sell one quantity. People will sell minimum, like minimum is one quantity, but people normally sell about 100 quantity. So say 100 quantity, if I sell, normally it is 2.5 rupees is what we gain and lose for one contract. For 100 contract, we will be gaining or losing 250 rupees for each tick. So the margin required is about 1.8 lakhs. So you say it is about 2 lakhs. The margin required is 2 lakhs. This is naked selling. The margin benefits will also come here. This is naked selling. So 1,97,000, say around of 1,80,000 rupees. For 1,80,000 rupees margin for each tick, you are going to gain either 250 rupees or either you are going to lose 250 rupees. This is risky. per tick, because USD INR moves very little only, means per day even it moves 0.1% or 0.2%. It is quite high, means USD INR is not very volatile. It will become volatile in certain event time, so that event time I will inform when you have to avoid doing a naked selling or you have to hedge. But USD INR is a very, very less volatile currency pair compared to the equities and MCX. So this is a very, very least volatile one. Forex normally is least volatile. Few pairs are very volatile, but USD INR is not very volatile, mainly because of some of our RBI's actions. Okay. Say 100 quantity means you are trading 100 lots. Okay. So one quantity is 1000 USD. So 100 quantity is 100,000 USD. So you are trading 100,000 USD for a margin money of only 1,79,000. The leverage here is very, 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 very high. Okay. For any our option contract, your one lot F&O, one lot equivalent of shares is somewhere about 5 lakhs, minimum of 5 lakhs, which is Reliance. So minimum of 5 lakhs up to the maximum of around 12 lakhs. Bajaj Finance, FinServ means those will be on the higher end, 12 lakhs. For that, you are paying about 84,000 rupees. For 12 lakhs only, you are paying 84,000 rupees as margin money when you are trading options. But in the currency, for 100,000 USD, you are dealing 100,000 USD, but you are paying around 2 lakhs only. Huge leverage it is. So that huge leverage means there is a huge risk. So you have to be very careful while trading on the currency segment. So keep your positions smaller. Don't even do 100 contracts, because every tick 250 rupees. Say every tick you say you will get 25 rupees. So go with 10 contracts or say 25 contracts. So this is fairly okay. If you lose, you will lose less. If you gain, you will gain less. So initially when you start trading in this, better to trade in 25 contracts, 20 contracts, like that means, like 20 contracts means it is 50 rupees per tick. So every tick you will either gain 50 rupees or you will lose 50 rupees. So this is more or less okay, like Nifty, it is more or less okay. Means try to do this. So once you are familiar with the movements and how to do firefighting, then you can increase your lot. Here for 20 lots means you are going to handle 20,000 USD worth contract. For that you are paying about 36,000 rupees only premium. Okay, the leverage is very, very high on the forex pairs. So be very careful while dealing with this. Okay, so let's what we do. This what I told is a naked selling. So what are the strategies commonly made with the currency pairs? Calendar, forget it. Currency pair calendar, not many people will do. Only very few people are doing, but very, very few. So normally on a currency pair, since it is very less volatile, most of the people will do straddle, short straddle, and most of the people will do iron fly, and many contracts is a iron condor. These are the three strategies, or it is a short strangle, means people will do short strangle, iron fly, iron condor, short straddle. These four strategies, two naked and two fully hedged. Okay, so first let us see that if we do a short straddle, I'll take example for 20 lots, because 20 lots means per tick either 50 rupees up or 50 rupees down. So that is for the 20 lots. So we will see how we are going to construct the strategy. We will do a short straddle first. Our spot is 75. So the short straddle is 75 CE cell, 75 PE cell. So let us do the basket so we will know. So let us do the USD INR. I'll do the new basket. So I had a USD INR, but now I am not doing currency, so that is why I closed. So we'll say USD INR weekly CE 75. So 14th October 75 CE. So I am going to sell this. The quantity is 20 quantity. Okay, overnight. So I am going to pay 35,870 rupees. I'll put limit order, no problem. We'll keep it as it is. So since you are receiving premium, so that final margin will become less. Okay. Now against this, you will sell a USD INR weekly 75 PE sell. Quantity is 20 quantity. We are going to sell whatever price is there, add. You can see the margin benefit is already given. So if you sell individually, you will have to pay about 70,000-80,000 rupees you may have to pay. But right now you will be paying only about 48,000 rupees. Close to like 40% you will get here. So this is the margin requirement for a short straddle for 20 lots. 20 lots means 20,000 USD. Means you will be collecting, how much you will be collecting? Here you will be collecting about 2,100 rupees, multiply by 2 means about 4,000 plus 4,250 rupees you will collect here. Here you will collect 3,050 rupees because you are doing for 20 lots. So multiply this by 20, multiply by 100. So let us see how much you will collect here. So you are selling 20 lots. 1,000 is your USD quantity. Multiply by 0.2125. So you'll be collecting 4,250 plus. So you are doing 20 lots. 1,000. This is 0.1525. So total you will be collecting 7,300 rupees on a margin paid for 48,000 rupees only. So how much is the premium collecting? You are collecting with respect to the margin divided by, you say, 48,000 multiply by 100. So you are collecting 15% of your margin as premium. This is more or less equal to 2012-2013 our index. Per lot we needed to sell we needed only 3,000-4,000 rupees. That kind of leverage is still available in the currency markets. Okay, but that is why be very careful with this. Very attractive means when you get all these premiums, very attractive. But when the position moves against you, the loss will be huge. Okay, so be very careful about that. So this is for the short straddle. So let us do a short strangle. No, short straddle we will do the iron fly. But short straddle you are doing. This is a naked, undefined risk. Means the huge up move or huge down move. This is not protected. This is not a defined risk strategy. So this is a undefined risk. The profit is higher because it is undefined. The loss is not defined. Okay. So if we have to make this as a defined risk, what we do, we buy 50 paisa above and we buy 50 paisa below. Same option we will buy one CE, we will buy 75.5 we will buy and 74.5 PE we will buy. Then you see that what is the margin benefit we are getting. So let us see USD INR weekly CE 75.5. So 75.5 we buy this same 20 quantity. You can see it is trading at about 3 by 4 paisa. Okay, add this one. So first we buy this, then we are going to buy 74.5. So USD INR weekly PE 74.5. 74.5 PE by 20 quantity. So this is trading at around 2.225. Add. See the margin benefit. The moment you do that, you get a huge margin benefit. For doing all these, you are going to pay only about 26,766, about 27,000. For 27,000 rupees, what is your gain? So we have seen 2125 multiplied by 2 plus 25 multiplied by 2. So this we got 7,300 minus we say 475 multiplied by 2 minus 225 multiplied by 2. I am going little faster because I know the formulas. So 5,900 rupees. So we are collecting 5,900 rupees of premium. Means net premium will be 5,900 rupees on a margin of 27,000 rupees. Let us say margin of 27,000 rupees multiplied by 100. 22% of the margin blocked. You are collecting it as a premium which has a huge risk. Here what is the risk? Here the risk is the difference between the strike. So multiply by 1000 minus your premium collected. Okay. So 75 and 75.5. So this is a 50 paisa difference. So 50 paisa difference multiply by, you say 1000 multiply by 20 contracts. Now you see the risk. So 0.5 multiply by 1000. So this is your, the strike difference is there. So multiply by 20. So 10,000 rupees of risk you are having here. Okay. And your premium collected, whatever premium collected is like 5,000 something. So minus that 5,900 you put. So this is your risk, 4,100 rupees of risk you are having here. Same risk you are having here also. Okay. So here when you do the iron fly, your risk reward is always higher. So here your risk is 4,100 rupees and the gain what you are trying to get is about 5,900 rupees. When you do the iron fly, if you are doing in a stock option or index option, the risk reward is quite high. Here the risk reward is a little bit lower. Okay. Here it is not even 1:2. Here it is around 1:1.2, 1.3. Okay. So this is a iron fly. Normally this is the strategy which people do because the USD INR is not going to move far beyond 75 or 75.5. If it is expiring within this or within this, we will gain a good amount of money, 5,900 rupees on a capital deployed of 26,700 is quite good in a week. It is quite good. Okay. Now, okay, we have seen this strategy. This is a iron fly. We have seen short straddle and we have seen iron fly. Let us see a short strangle. Short strangle means selling out of the money call and selling out of the money put. Okay. So let us do USD INR weekly CE. I'll sell 75.5. I'll sell this or I'll sell 76. 76 CE I'll sell about 0.1. I'll sell 20 contracts about 23,000 rupees. So 0.01. So it is trading at about 1 paisa. It's not 1 paisa. It is multiplied by 1000. So multiply 1000 means you will get 100 rupees here. Okay. Add. So you pay 23,193 and you will sell the PE also. So USD INR weekly PE, let us sell 74.5 itself, so no issue. So 20 contracts. So you can see it is trading at about 2.25 paisa. So let's add this one. No, I put a buy, so it is a sell. So you sell this one, you will still get a margin benefit because if you sell both independently, you will have a higher margin. Here you will be having some margin benefit. So this is a short strangle. So in the short strangle, it's what you are getting as a premium is you are getting 20 contracts, 100 rupees. So you are getting 1 paisa means you say 0.01 multiply by 20 multiply by 1000. So you are getting about, yeah, 200 rupees. That is correct, 200, because you are selling at 1 paisa, you are going to get only 200 rupees. So 74.5 you will be getting 225 multiplied by 2, 450 rupees. So you will get about 600 rupees here, means not more than 600, 650 rupees you will get here. So for 650 rupees you are going to pay about 45,000 rupees. So not very viable, means for just getting 600, 650 rupees and handling a huge risk. You are getting 650 rupees and you are paying about 45,000 rupees. So not very suitable. So, but people do short strangle here. Maybe since the market is closed, the premiums are like this. Maybe like if we get a live market, the premiums will be better. So let us see the next one. We saw the short strangle. So the same thing, just buy 2 options further out of the money, you will get iron condor. So let's see means how we will construct the iron condor. So first we will buy USD INR weekly CE T5.5. So sell this 20 contracts. So 475. So sell this. So 75.5 we sold. So now we are going to buy a further higher contract. The higher contract is 76. Okay. So you say USD INR weekly 76 CE, buy 20 contracts, buy 200 rupees. Okay. Then PE side. So we go USD INR weekly 74.5 PE. So we sell this 20 contracts, add this, and lower PE, say 74. Okay. USD INR PE weekly 74 PE. The contract is not traded, that's the problem. Let's say 0.01 here. So this should provide something here. So you will require about, for the iron condor, you will require about 31,000 rupees. Earlier you saw for the short strangle you will require about 45,000 rupees. So here you require about 30,700. So 31,000 rupees, consider like that. Here the premium collection will be slightly lesser than your short strangle because you are paying some premium back. Like it is something like this. You are paying some part of the premium back for the hedges. So here you will get some cushion like 75.5 and 74.5. So there is 1 rupee difference is there. Right now it is the right in the middle, 75. The USD INR does not move very much. It does not go to 74.5 or 75.5 in a normal day. On a even day it can move like hell. So on a normal day the movement of USD INR is hardly 20 paisa, 15 to 20 paisa, not more than that. Means it moves like that. At some cases it can move gap up by 1 rupee, gap down by 1 rupee. That time people lose money like anything. But in a regular normal conditions the USD INR is very less volatile. It does not move much. Okay, maximum 25 paisa. It does not move more than that. So that way we get a very good cushion. 50 paisa above and 50 paisa below will get a cushion. Even it goes further down, so our risk is already capped because we already purchased a 50 paisa above CE and 50 paisa below PE from the sell strikes. Okay, so this is a iron condor setup. Many people do the iron condor also. This is a risk defined setup. Here your maximum loss is already defined. Okay, here what is your maximum loss? So your strike difference multiply by your contract multiply by your lot size minus your premium received. So that is your risk. So that risk is less here. The risk is a little bit higher than your short straddle or the iron fly, means which we saw as a hedged version of the short straddle, but the probability of profit is slightly higher than the iron fly. Okay, because we have got a 1 rupee cushion here, that is why the pop will be slightly higher. I hope I have given you a good primer for the USD INR option trading in the currency derivative segment of the Indian markets. So I hope you have learned something new from this session, and I hope, like, if any doubt is there you can ask in the YouTube comment section. I'll see all the comments and I respond to that. Or if I am not responding, you can always ask in the Nifty BN Telegram group. To join the Telegram group, the link is provided in the description of the video. So you can join that group, and 16,000 plus members in the group. Actively per day we are getting more than 2,500, 3,000 messages in the group. Very active group. So can learn more from that group. I hope you have learned something new, or you have refreshed what you have learned about the currency segment. Signing off, this is JR. May the markets be with you. Thank you.
Thank you for watching. Please post any questions you have in the comment section. Also, do not forget to like and share the video and subscribe to the channel. To find us on Twitter, Telegram and Facebook, use the username NiftyBN. Also, we post some of our trades to the community tab. So do not forget to check that from time to time.